Welcome to FinScale, a podcast created by Solène Niederkorn, shedding light on innovation in finance, banking, and insurance.
Scaling new heights in treasury management. Kevin Cook, CEO and co-founder of Treasury Spring.
It took us, we came up with the idea in 2015. We launched the business very beginning of 2016. It took us until June 2018, so 2.5 years, to understand the legal environment, understand the regulatory environment, put in place the service providers from an operational perspective to be able to do what we wanted to do, build the first prototype for the technology, build our own internal workflow engine to make sure that we could build something that could scale. So, I think I remember telling my wife that it would probably take 6 months. And 2.5 years later, we finally launched it.
In this episode, I revisit the world of treasury management, a realm I've been deeply involved with since my younger years. It's a world filled with T-bills, certificates of deposits, and repos. Managing treasury involves placing funds, effectively managing risk with clear visibility and transparency, and accessing institutional markets. My fascination with this subject is shared by my guest this week, Kevin. He shares insights into the FinTech company he co-founded, which is revolutionizing how clients manage their treasuries with a sophisticated approach. This London-based scale-up has moved beyond traditional Excel sheets, developing fixed-term funds to enable more sophisticated management. You will learn about the financial product structure, the diverse client base ranging from private equity fund to large listed corporation, their outreach strategies, and their geographical focus. It's an inspiring journey akin to scaling the north face of Everest. Enjoy the show. Hello, everyone. Hello, Kevin.
Hi, Solène. How are you?
I'm fine. Thank you very much. I'm super, super happy to have you on my podcast and very excited to know more about what you build at Treasury Spring. To be honest, I'm really impressed by the journey you've made. When Yann Rancher talked about you a few months ago, where we had a discussion at Money 2020. And then just afterwards, I went on your website and checked everything, and I was really impressed. So congrats for this.
Oh, thank you very much. It's been a while. It's not always a smooth, perfectly straight line, but yeah, we're happy with where we're getting to.
Excellent. Kevin, can I ask you to introduce yourself and tell us a bit about yourself and go back to your time before entrepreneurship?
Yeah, of course. So, Kevin Cook, I am one of the founders and the CEO of Treasury Spring, which is a London-based FinTech in the cash management space. So I started my professional career as a lawyer back in 2002. Sort of went through school, persuaded by my parents that being a lawyer was a good career and that's what I should go and do, and worked in a big corporate law firm for 4 years, but realized pretty quickly I didn't like only getting involved after what seemed like all of the fun bits of transactions had been done. And so in 2006, I took the decision to leave the law and I went to a hedge fund, which is where I met Matthew and James, my two co-founders. We worked there pre, during, and post Lehman, which was a pretty interesting time to be kind of cutting your teeth as an investment professional. We learned an awful lot, and a lot of those lessons that we learned through Lehman, I guess, impacted and still guide the way that we do things and the way that we think about the world and the way that we offer products to our clients today. After the hedge funds in 2010, we set up our first business to some extent by necessity, in that we'd worked, the hedge funds had its problems through Lehman, and we were left with the opportunity of saying, do we go out back into the job market, or do we try and do this unique entrepreneurship thing where we were fortunate to be able to have a client from our hedge fund who gave us some guaranteed revenue to start with. And so in 2010, we set off on our entrepreneurship journey, not knowing exactly what the future would hold, but sort of feeling excited. And then I guess we accidentally fell into cash management sector that we're in now. Later that year, when conversations with a large hedge fund manager drifted towards what was on their mind, what were their biggest problems. And it turned out that their biggest problem was, unusually, that they were sat on $10 billion worth of excess liquidity. And that had been a great thing pre-crisis because interest rates had been high at 5% and people hadn't been worried about credit risk, and prime brokers had been desperate to allocate balance sheet to all of their hedge fund clients. But obviously, all of those things had changed through Lehman. The hedge fund manager had figured out that probably that meant that he should change what he was doing, but he was in the commodity trading advising space. So algorithmic trading, he had 150 PhDs who worked for him, but nobody who knew anything about fixed income. And so that journey, that option was presented to us as people who knew about fixed income to say, would you like to come and look at this? And that was really our gateway to cash management. We built an advisory business in the cash management space from 2010 to 2013. Sold that to an asset manager in 2013, ran short-dated fixed income still in the cash management space at the asset manager that we sold it to, and then left to set up Treasury Spring in 2016 and have been building it ever since. And maybe I'll talk a bit more later about some of the decisions that kind of guided us on that journey, but that's the short version.
It's funny because when I started my career in early 2000, I was working in the hedge fund industry and I was doing exactly this. So managing cash and it was millions and millions every day. So I told you each episode of the podcast explores one specific topic or one pain point. And I would like you to go into more details and tell us more about that biggest challenge, the big challenge of cash management, and how you deciphered that pain point and how you managed to meet treasurers to see how complicated it was for them and help us understand the pain point faced by those treasurers.
Yeah, so I think if I kind of go back to 2010 or even a little earlier to 2008 and sort of sitting in a hedge fund through Lehman, obviously you witnessed the collapse of one of the largest brokers in the world at the time. You witnessed the near collapse of the entire financial system on the back of it. And looking at that, you sort of try and understand how it happened. And ultimately, everybody talks about it being the subprime mortgage crisis, but a lot of what led to Lehman going down was very intrinsically linked to the cash management markets. It was linked to the money markets because a lot of what Lehman was doing was funding itself overnight through the money markets and investing out for longer in all sorts of other assets. And so when people started to get worried about Lehman, what happened was that there was a mad dash for liquidity. Everybody sort of started to panic and everybody said, okay, I want my money back. So they went and pulled it, not just from Lehman, but they pulled it from other banks. They pulled it from their money market funds. And what happened then was that the money market funds who were lending to Lehman and providing Lehman its biggest source of overnight liquidity didn't roll over any of that financing. And actually, it was that maturity transformation, it was that concentration on short-term funding that caused, firstly, the collapse of Lehman and nearly caused the collapse of an awful lot of money market funds because of the maturity transformation that they engaged in with their clients. And so it really taught us lessons about correlation and how correlation things can look uncorrelated. And then when they go bad, correlation suddenly goes very quickly to close to 1. It taught us things about maturity transformation and the risks in maturity transformed vehicles, whether they be banks or funds or what have you. And so when we then started talking to some very sophisticated treasurers, people in hedge funds who'd kind of witnessed this and had the scars of it, the first thing that people wanted to do was to say, how do I diversify and reduce my risk? Let's not think about yield for now. I'm still pretty raw from Lehman. I want to know, how do I mitigate risk in the first instance and make sure that when I need my money, it's there and I don't have to worry about credit. And so, first principles were, how do I diversify? How do I get access to the closest thing to the risk-free rate, which if you're not a bank, so you don't have access to the central bank, is government assets. How do I get access to government assets? How do I then diversify? And then how do I take security? Because ultimately, we have this funny world where if the bank lends us money to buy a house, for example, it doesn't say, Selene, you look like a lovely lady. I'm sure you're totally trustworthy. Here's the €1 million. And you just pay me back when you pay me back. It says, no, sure. I'm sure all of those things are true, but I'm going to lend you the money, but then I'm going to take security over your house so that if you default, I can sell the house and I can get my money back.
Clearly.
When we lend to the bank, no. You just give us the money. We'll pay you back one day. It's fine. Don't worry about what we do from our business perspective. And so other than deposit guarantee schemes, which obviously across the world are different levels. So in the UK, it's £85,000. In Europe, it's €100,000. In the US, it's $250,000. Any money you place with a bank over and above that is unsecured. It's an unsecured loan. We have this fancy word for deposit, but it's really an unsecured loan. And so, the smart people post-financial crisis were, well, okay, these unsecured loans don't sound like such a great idea. How do I take security? How do I make sure that I've got collateral so that if there is a credit event, I can get my money back? And so the first pain point that we've been trying to solve for, really from 2010 onwards, has been risk reduction. And that risk reduction can take kind of three forms. It can take getting access to the government. It can take taking security. And it can take diversification. If you can do those three things, then you can get to a pretty good place from a risk reduction perspective. But then the other big pain point, which you have to kind of play into this, is that most of the people, most of the teams managing excess cash outside of a bank or a big asset manager are pretty small. They're pretty stretched. They're doing lots and lots of different things.
Yes.
And cash investment is just a small part of it.
Yes, and I would say it's not so much my impression when I was managing cash in hedge funds. My impression is that those functions were not considered as front functions, rather back office functions. And people didn't have also the tools to do this. Analyze the risk, for instance, it was really like on Excel and managed on Excel. And I don't think that things have moved so much those last 20 years. You confirm?
Yeah, and you're exactly right. It was like that then, and for lots and lots of organizations, it's still very much like that now. And so you have this big gap between, okay, if I understand risk, which is the thing that I'm told by my CFO, by my board, by my CEO, whatever I need to, like, that's my job in Treasury, is to manage risk. I might know that I should do these things, but I don't have the bandwidth to do them. I don't have the team size to do them. I don't have the budget to do them. I don't even have the resources or the expertise to do them. And so you end up with this kind of nasty problem, which is, I know I should do something different in order to achieve my primary job of risk reduction, but I'm stuck. I can't do it. And so what do? I do the same things that people have been doing with excess cash for the last, 50 plus years, which is I put it just in my bank. And maybe these days people are like, okay, I understand that there are some banks that are riskier than others. Hopefully on the back of things like Silicon Valley Bank last year, people realized that you should pay attention. But nevertheless, even if you just said, I want to put it in 10 different bank accounts, I don't have the bandwidth to open all of those bank accounts. I don't have the knowledge to even build those relationships. I don't have the technology to be able to manage the payment flows from all of the different bank accounts. And so it was a really hard problem that lots of people have struggled with for a really long time, which is, I should do something better, firstly, to minimize risk. And yes, particularly in this interest rate environment, to maximize yield. If you're earning the difference between 5% and 0% on some millions or tens or hundreds of millions of dollars is a lot of money. So I should be trying to do something to firstly minimize risk and secondly maximize return. But I have this constraint of time and expertise and connectivity, and I can't solve those three things. And so that, I guess, is the pain that we're trying to solve for.
In terms of volume, so you mentioned hedge funds managers. What are the main concerned institutions or managers or players in the industry having that problem of cash management first? And second thing, regarding the multi-currency problem, because the environment I know, it was only managing euro and dollar, so not very complex. But when you need to manage the cash in exotic currencies, is this an additional complexity?
Yes, so I'd say in terms of the people who have the problem, pretty much every institution, and the problems are different. So even if you're a big investment bank, you have some of these problems, and the shape of the problems is different there because maybe you have the infrastructure, you have the resources, you have the team size, but you have a bunch of regulatory constraints that get put in. But if you ignore the banks, the asset managers, the big fixed income hedge funds, because they have problems, but they're just slightly different. kind of everybody from your Eurostoxx 50 or FTSE 100 or Fortune 500 corporates, all the way down to your Series A scale up, has a flavor of this problem, in that everybody is time poor, everybody is resource constrained, and everybody is left with a traditional solution of just placing money with your banks, either directly in deposits or indirectly through prime money market funds, which is suboptimal. So it's a problem across the piece. Just the scale and the difficulty of it is a little different. And to your question on currencies, I guess, yeah, certainly as you get towards the mid-level companies, mid-market and upwards, we find most companies have multiple currencies. And as you said, it's hard enough to manage multiple currencies in just the core currencies, so sterling, dollars, euro. But if you've then got exotic currencies and you're having to place money in those local currencies, and you can't find globally systemically important banks that you can place it with in those markets, so you might be placing it with a local bank. And how do you understand that from a credit perspective? How do you understand what the resolution procedure is in a less developed market? And so that absolutely is also a challenge for people. And then throw in cross-currency risk and all of these things too.
Okay, so we understood the pain point. Thank you very much. So it's a huge pain point. So where did you start? So when you first developed your product, what was the main pain point you worked on, and what was the first product that you shipped?
Yes, I think it's worth pointing out that it took us 7 years to figure this out properly.
Yeah.
In that we started with advisory, but then we realized that advisory was useless to all bar a very select group of clients because they didn't have the ability to take the advice. You could sort of tell them what they should do, and they said, "Oh, it makes perfect sense, but I don't have any of the things necessary to do it, and I'm not about to get a multi-year, multi-million pound treasury transformation budget put in place to go and build this out directly." So we sort of spent a few years doing advisory, were successful with a particular set of clients, but it didn't work for everybody else. And then we went to managed accounts and said, okay, we can not only tell you what to do, but we can also offer you a managed account, which can give you the ability to put that for somebody else to put it in place for you. But it was still too time consuming, too complicated, too difficult to understand, too difficult to explain. Like, it wasn't a scalable solution. And so when we launched Treasury Spring, it was, how do we find a way to deliver standardized, regulated, low cost digital access to what we know are the best cash investment products to the widest group of clients? And so that was what we were trying to solve for in the first place.
What a challenge. But you managed. It took you 7 years, but you managed.
Yeah, and so then we launched Treasury Spring, and we said, okay, we need to be able to deliver these things. How do we do it? And how do we do it in a way that looks and feels like something that people already do? And as we talked about, the things that people already do, bank deposits, money market funds, that's it. And so we didn't want to be a bank. That didn't really solve any of the problems. But we knew quite a lot about funds, given our background. And so we set about saying, can we use funds infrastructure to deliver a new product to our clients? Because funds are great because anyone can buy them. You can buy a fund, I can buy a fund, a corporate, a family office, a charity, anyone can buy a fund. You don't need to put anything in place to buy it. But as I mentioned earlier, we didn't want that maturity transformation. We didn't want that kind of those to bring in any of those risks that we'd seen firsthand through Lehman. So we said, can we create a different type of fund, which is a fixed term fund? So a fund that exists for 3 days or for a week or for a month or 3 months, whatever it might be. But that fund only ever exists for a finite period of time. And inside of that fund sits one asset, and the term of that asset matches the term of the fund. So to your question, the first product we ever shipped was a 1 week UK Treasury bill fixed term fund. So the principle was, going back to what I said earlier about getting access to the risk-free rate, getting access to the government, how do we deliver access to the government without the need for custody accounts, infrastructure, dealers? And we said, well, okay, we put in place the infrastructure to face the market to buy government treasury bills. And then the client says, I want 1 week UK government exposure. So they buy, the first ever transaction was £100,000 worth of UK treasury bills. They buy £100,000 UK treasury bill fixed term fund. We buy £100,000 worth of UK treasury bills. They want 1 week maturity. We buy a 1 week asset. The 1 week asset sits inside the fixed term fund. The client owns the fixed term fund. For that week, they have access to the risk and return of that fixed term fund. On maturity, the Treasury bill pays back, the client gets their money, and then they can choose to take their money back or go into another fixed term fund. So we were just trying to find a way to deliver access to the asset cleanly, without maturity transformation, without infrastructure, in a way that clients could easily explain internally. And so that was kind of the first products that we ever shipped were UK Treasury bill fixed term funds.
And it seems quite complex. Did you use a law firm to build the product? And how did you organize, because you have an orchestration of different players, to have access to the T-bill, to organize the fund itself for the subscription and redemption transactions? So how did you do it internally?
Yes, it took us, we came up with the idea in 2015. We launched the business very beginning of 2016. It took us until June 2018, so 2.5 years, to understand the legal environment, understand the regulatory environment, put in place the service providers from an operational perspective to be able to do what we wanted to do, build the first prototype for the technology, build our own internal workflow engine to make sure that we could build something that could scale. So, I think I remember telling my wife that it would probably take 6 months, and 2.5 years later, we finally launched it. So it was a little painful. There were lots of kind of ups and downs along the way, but the vision was always the same. And we had to build something that was scalable at an institutional level. So we had to use the best law firms. We had to use a Big Four accountancy firm. We had to use a reputable fund administrator. We had to use one of the largest custodians in the world. So putting all of these things in place takes time and persuasion and money, ultimately, in order to get it up and running.
And when you built that first product, were you envisaging scalability? And is this model that you built in the beginning was scalable and remains the model and the infrastructure that you've built 5 or 7 years ago? I don't remember exactly the days that you provided.
So I guess one of the benefits to the fact that it took us a while to get this up and running was that we had plenty of time to really plan it. And we always knew that in order for this to be a valuable business, it was going to have to get to reasonable scale. And so it was, we're building our infrastructure. It was, how do we make sure that there's something that works not just for today, not just for the prototype, but works for something that we can scale this to thousands of clients, to billions of dollars of assets, to hundreds or thousands of products, to multiple different settlement systems across multiple different currencies. And so James, my business partner, is our CTO, and did a brilliant job of building the original technological blueprint, which we still operate on today. And Matthew, my other partner, our COO, did the same from an operational perspective. And so things have changed, of course, over time, but the fundamental principles that we operate on today are exactly the same ones that we operated on when we first launched 5.5 years ago.
Impressive. There is something that, because you mentioned a lot of different players and diverse players that are facing that pain point, how complex it is to solve the pain point of the CFO of Series C, a scale-up company versus another CFO of an SME. So you have a variety of clients. So how do you address and what is your go-to-market strategy for that such a complex variety of clients?
It's a really good question. And it's been one of the challenges for the business, I guess, is that the benefit of what we do is it can be applicable to everybody. But to some extent, that's also a downside, because you have to be able to sell and have a clear go-to-market strategy. And so we quite deliberately, for the first 18 months, we weren't very public about what we were doing. We didn't do any marketing. We just went and talked to lots and lots and lots of different clients to say, okay, we understand you probably all have some version of this pain point, but what's the feedback that we're getting? Where are the areas where we're pretty sure that there's a really strong value proposition for here? And so, we have clients from multiple different sectors. But I guess when we did our Series A, back in 2020, we really focused in on a few different sectors. So one was the venture capital-backed community, so the scale-ups. The problem there has historically been one of large pre-funded pools of capital come into a business. Often it's a young, relatively inexperienced finance director. There might be one banking relationship that they have, and you've got a gazillion things going on all at the same time. And so, we were telling the venture capital community for years that they had a problem with SVB, because people were just like, oh, it's fine, we'll put it all in SVB, because they didn't have the time to think about anything else. And so, the pitch to that sector for years was, you have to diversify. And by the way, when money was abundant in the venture capital community, people were less worried about risk. They were less worried about extending runway because it felt like there was going to be cheap equity forever. Guess what? Those things changed 2022, 2023, as people woke up to the fact that firstly, you can't always raise cheap equity forever, and so it makes sense to make the cash that you've got work for you. But also from a risk perspective, you shouldn't just be leaving it in one bank. And so in that market, that sort of pitch of keep your working capital where you need it, but then try and find a tech solution to distribute it across other counterparties for the non-immediately needed working capital, is something that really resonates. And it's something that really resonates with the venture capital fund managers today. And so go to market in that sector has typically been to work with the VC fund managers themselves, both for their own cash, but then for their portfolios, because they, their risk is ultimately in the cash that they provide to these companies and where that sits from a credit perspective. And so, so that's that sector. And then we also focused in on the corporate sector. So if you're a large corporate with $1 billion in cash, and you're the treasurer or the treasury manager, you worry about this stuff, right? Like, there's a lot of money that you've got to find homes for that has to be safe. And so the pitch to that community is really, yeah, sure, you might have lots of banks already, you might have some money market funds, but do you have access to the secured lending market that I talked about earlier? Do you have access to the repo market that you were accessing at the hedge fund way back 20 years ago? Almost no corporate treasurer has access to the repo market, even today, because it's too time consuming, too cumbersome. The legal documents are far too long. The infrastructure and operational setup is too painful. And so it was, okay, you're going to need your relationship banks. You might want some daily liquidity, which you can put in your government money market funds. Ideally better than prime, but the pool, you've got a pool of cash that should be earning you some return, but should be really focusing on that security piece. Use us as a tool, an additional tool in your toolkit. And so in that space, it's been much more direct marketing to the underlying large corporates. We work with industry organizations like the Association of Corporate Treasurers, or ATAL in Luxembourg, or the EACT across Europe, in order to raise awareness, but much more direct go-to-market strategy. And then the third vertical for us is the private equity space, which is sort of a larger, slightly more complicated version of the venture capital space.
Interesting.
Where you have fund managers have funds, they also have portfolio companies, they also have partners, they also have carry vehicles and other things. And so we're able to, again, sell directly to the fund manager, but use the network to sell across all of the other areas in the ecosystem. And
now, currently, your clients are mainly in the UK, in Europe. So can you just give us a few figures, proportion?
Yeah, so I think as of today, we have just over 340 clients. They are, by number, 75% in the UK, although by assets, only 55% based in the UK. We have most of the rest, so call it 20%, in other places around Europe. So we actively market into the UK, the Channel Islands, Ireland, the Netherlands, and Luxembourg. And then we have a small but growing client base in the US. So we got authorized to distribute into the US last year in 2023. And we plan to open our first office in the US later this year.
Wow. So this is the client side. Now on the issuer side, so you need to find new issuers. You need to also screen new issuers. So how do you organize this part?
Yes. So our products are broadly grouped into three verticals. So we have government and government-like assets where, from our perspective, we have built all of the infrastructure, relationships, connectivity to be able to go into the market and source those assets from our dealer relationships. And so we have a credit process that goes through our product team around which currencies do we want to operate in, which government and government-like institutions in those currencies can we offer, do we want to offer. But we have a pretty well-oiled process for adding those to the platform now. So that's the government sector. Then we have the bank sector, which is sort of the largest and takes up the majority of our time, which is going and directly originating secured, ideally, funding relationships with major global investment banks. So when we do that, we have to go out into the market. We have to build a relationship with one of the major global investment banks. So we operate with people like Barclays, with people like Goldman Sachs, with people like Bank of Montreal. But these are sort of major global investment banks where we are their client. We have to put in place, they have to do all of their KYC, AML, credit understanding on us. Then we have to put in place the legal agreements, which are quite painful. They have really catchy names, things like Global Master Repurchase Agreement or Global Master Securities Lending Agreement. We have to put in place all of the institutional infrastructure to be able to lend to them through these things called tri-party agents. And so, the average setup for adding a bank might take us anywhere from at the very short end, probably 6 to 9 months. And in many cases, it's years from starting the relationship to getting everything up and running.
And it's manual work most of the time. I mean, you didn't...
absolutely. We have a legal team and an operations team and what have you. And unfortunately, there's no...
Not yet.
...substitute for going out and there's no shortcut. But I guess the joyous thing for our clients is we're doing all of this work so that they don't have to.
Yeah.
They come to our platform and they get access to, literally years and years and years of man hours or woman hours of building this stuff out. And all they do is they do one KYC, one AML, one digital onboarding, and they have it all at their fingertips. And so what might have taken us years and cost hundreds of thousands of pounds to set up, they type some numbers and click some buttons and they've got it.
Yeah.
And so that's sort of a large part of the value proposition for us is we built all of this so that our clients don't need to.
And is there a lot of work on your side because your clients have to check you as a counterparty? So there are certainly some due diligence for big corporates rather than scale-ups. So how does it happen? And is it cumbersome sometime? How long does it take?
I guess when we first started and you go out and you pitch to the large corporate and you're like, okay, we've built this entirely new asset class and we're this entirely new company. Just come trust us with this. That is not an easy conversation to have. And so someone described it to me when we set up the business as you're going to have to catch a smaller fish to catch a bigger fish to catch a bigger fish. And eventually you get the really big fish. And to some extent that was true. And so, now we have several large listed companies, both in the UK, in Europe, and in the US, who use us. And as a result, we have a very wide variety of collateral on everything that you could possibly wish to know about us, from our legal structure to our regulation, to our operational processes, to our KYC and AML. And so that due diligence process is naturally, for the large customers, can take quite some time. But the good news is when you've got the logos of some of our large clients that you're able to put on the website, so people see the Schroders name or people see the Whitbread name or whatever it is, there's cumulative due diligence, there's cumulative comfort that people can take from that. And so the process gets shorter and shorter. The number of questions we ask get asked gets smaller and smaller, and hopefully our responses get more and more buttoned up and exactly to the point that people are trying to solve for. Mm-hmm. So for our very large clients, the actual onboarding process might only take a few days, but the due diligence process might take some months for people to get from there. But it's definitely shortening.
It's impressive. Congratulations. I have so many other questions, but I have to stick to my timing, except if you want to mention something additional. So my last question would be about your next steps and what you're envisaging. So you were mentioning the US opening soon. And what else could you share with us?
Yeah, absolutely. So there's three main things for us focusing on this year. The first is kind of doing the same thing we've always done in the same markets we've always done it. And so there's still a long way for us to go in terms of growth in our core markets by just adding more products, by continuing to improve our technology, by continuing to add clients. And so, that's always the core focus for us, is just do what we do best, but continue to do it better. On top of that, as you mentioned, expanding our geographic footprint. So still doing the same things that we do today, but doing them in different places. So we hired our first European sales people last year. As I mentioned, we open in the US later this year. And so starting to build out that geographic diversification. And then the third one is offering new products to the same client base and then ultimately to the expanded client base. So in terms of new products, there are always new products and features that we're developing, but a couple of more material things that will change for our clients at some point this year. One is offering a credit reporting tool. So something that, particularly in the aftermath of SVB, Credit Suisse, First Republic last year, what we saw was there are lots of CFOs asking their treasurers or CEOs asking their CFOs, okay, sure, my money's here, but what's the credit of these institutions? People don't know, people don't have access to the tools. And so we're building a tool that will enable that to be really easy for clients to be able to see, okay, what have I got? And what does the credit look like? And how's that tracked over time? And how does it compare to the broader market? And then the other one is something that you mentioned earlier, which is we have people who operate in multiple different currencies. And we have a lot of interbank relationships where we can execute FX in an efficient way. But up until now, clients have sort of placed cash on the platform. If they wanted to then put it into a different currency and then place cash back on the platform, they'd go and do that away from us. They'd go out to a bank or a broker in order to do that. But we will launch the ability for people to redeem and switch their fixed-term funds in different currencies later this year. So they're the main developments for us over 2024.
Okay, good luck. So to conclude, Kevin, I would like from you a sort of a recommendation. So it can be a book or podcast or movie. It's the final word.
So maybe I give a podcast and a book. So for podcast, I'm a big fan of Lex Friedman. He interviews some fascinating people. I love the long form version of the interview. I think stuff like this is super valuable. The 30 minutes short, but I also love the really getting in depth and getting under the skin of people over a longer period of time. So I love listening to all of his interviews, and he's done some fantastic ones with people like Jeff Bezos and Mark Andreessen and all sorts of really interesting people. And then probably the book I read last year that maybe influenced me the most was maybe The Tipping Point by Malcolm Gladwell. So just a really interesting book on virality and how that applies to everything from infectious diseases through to building businesses. Yeah.
Thank you very much, Kevin, and congratulations again, and see you soon.
Thanks, Hélène. Really nice to talk to you.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.